Here we go. Happy Thursday. We're live. It's 10 a.m. It's Real Estate Now coming at you. Keith Pitch. Stacy, what's going on?
Stacy Chevalier here. Happy Thursday. Things are good. Hanging out in the office again. I'm excited.
Nice.
All by myself.
So the office there, I'm curious. What's new in the office since we're not in there except you?
A lot of mail.
A lot of mail. Okay.
Yeah, but everything is just as we left it in March.
No, that's good. I do want to go grab one of those beanbag chairs. I think would look good in the treehouse here, just kicking in the corner. So
yeah,
I may do that. I don't know if that's offline or appropriate. I'll bring it back when we open the office again, but just throwing it out there. I need that. So today's show, it's a little different, right, Stacy?
It is. It's going to be the Keith and Stacy show, but first we're going to jump into the rates because something really cool happened yesterday.
Okay, there we go. Hey, technology. What really cool happened yesterday, Stacy?
We hit like the lowest rate ever.
Ever. And it's just kind of plateauing right now. So we're just kind of hanging out there. So, we had this little spike right at the beginning of the year, and then we dropped that little spike back down. So we're just hanging out there in the mid-low or mid-high 2% on the 30-year fix, the 15 years touching 2 and at 2.2. And then, there are a little bit of fees associated with that. Just want to make sure everybody's seeing that. 0.5% of fees on the 15-year, and then 0.7% in fees on the 30-year. But yeah, we're off to a record low, historically record low. So my question back to you, Stacy, does that mean we're going to hit it 16 times, or we're going to notch down 16 times throughout this year like we did in 2020?
I don't know, but I mean, I did think rates were gonna go down, but from a high to a low, it's a little volatile. I think we're gonna be in a low rate environment for some time.
Well, I not to get too deep on it, but I think it has to go back to, we are still in this pandemic. We are still looking to do a lot of stimulus at the federal level to help people out, and that will keep rates low. The Fed said it yesterday. The markets reacted to it yesterday, and so we're here. Doesn't mean you guys should prolong or put off the event of refinancing or buying that house and locking in this cheap money, because we never know when it's going to stop. Right? It's like musical chairs. When it stops, you best grab a chair, and we just don't know when it's going to stop. So buckle up and let it happen. So we alluded to it, changing topics and getting into today's show. Stacy and I, we did a little soul searching, and we wanted to once a month bring you guys a little mortgage nugget of goodness, right? So an educational show about mortgage finance. We've had lots of guests on, from business planners to civil leaders to real estate agents helping us out, knowing what's going on in the market. But we wanted to add one extra layer of helping you guys out with some financing knowledge. And today is the kickoff of that. And we're going to talk about a really interesting topic. What do you think about today's topic, Stacy?
Well, I think it could go down a million different paths. So I'm gonna try to ask the questions that I think a consumer would ask as we walk through these topics. But yeah, it just depends which way we go.
So let's set the stage. We're going to talk about ways that you, as a current homeowner right now with a house and a mortgage, could go out there and buy your next house in a non-contingent fashion using a mortgage. Right? Mortgages, folks. Mortgages are tools. They're there to be utilized. They're financial tools to help you achieve your financial goals. And a lot of people don't know this, and I'm still amazed every time that I talk to real estate agents in our community. I talk to financial planners. They don't know that these tools are available or that they could access your equity in your house, in the ways that we help people access the equity in their house and be non-contingent offers. So this is playing to a bigger issue that we have right now, especially in Seattle and the greater Puget Sound area, that we don't have enough inventory. And Housing Wire, the Master Builders Association, the Mortgage Bankers Association, they're all saying one reason is, and I think we said it last week, people are staying in their houses longer, right, Stacey?
People aren't selling their houses. Yeah.
They're not selling.
It's gone up a couple of years in the last decade of how the length of time people are staying in their homes. Yeah.
Right. It went from like 8 to 13.
Yeah. And part of that might be because they don't know if they sell, if they're going to find that next house, right? So, which brings us back to, if you are, maybe you're someone that you don't want to own 2 houses, but you just want to move once. So let's start that conversation at that point, Keith. Someone who's not going to end up keeping the house that they're departing from, but they don't want to go non-contingent offer.
So the problem is, you want to buy a new house and you can't, because all your cash, boom, is tied up into the house that you have, right? This is a very, very common problem. There's solutions out there for you guys called bridge financing solutions. And we're going to talk about 3 of them today. There's more than just the 3 that we're going to mention today and go through. But setting the stage, it looks like this. You purchased the house, I'm not going to say 13 years ago, but let's say you bought a house 6 years ago. And at the time that you bought the house, maybe you bought it for $500,000 6 years ago. Fast forward to today, that house is worth $800,000 or $900,000, and you've got a mad chunk of equity in there. How do you get at that equity without selling that house or becoming a contingent buyer, i.e., hey, we'll buy your house once we sell our house, will you take our offer? And if you've talked to any real estate agents or real estate agents out there, you feel me when I say that offer is not competitive in the least, right? So bridge financing allows you as the homeowner to tap into that equity, take that equity as the down payment for your new house, and then buy non-contingent. Right? You'll deal with the departing residents when you move all your furniture, and if you have kids, your kids. If you have pets, your pets into the new house. But this is how we help you bridge that gap of being a non-contingent buyer. So super, super powerful stuff. There we go. We lost there.
Can you hear me?
Yeah, we can hear you.
I'm just frozen. Do I look frozen on your side?
You do look frozen, but your voice is not frozen.
Okay. I'm just gonna mess around with the camera. Here we go.
Huh, interesting. So a couple things, the 3 that we're going to talk about today, we can still hear you, Stacey, so I think we'll just keep rolling on if you're cool with it.
Yep, we're cool. Keep going.
Yeah, so the 3 bridge financing options that we want to talk about today are home equity lines of credit, a straight up cash out refinance, which gets overlooked so many times. It's really, honestly, one of the simplest paths to be a non-buyer. Pulling the equity out and new first mortgage, using it as your down payment. And then the most complicated of the situations is what's called a cross collateralization loan, where we take the 2 values and we put them into one loan, and we'll talk about that a little deeper. But one thing that I want to set the table with before we jump, let's see here, there we go. All of these financing options, you need to have the conversation. Start the conversation with your loan officer, start the conversation with your real estate agent, and see everybody's numbers are going to be different, right? Everybody's mortgages balances are going to be different. Their sales prices are going to be different. Their purchase that they want to go is going to be different. So you got to work the numbers and know what numbers work for you. So jumping into our first option, it's a home equity line of credit. The home equity line of credit is adding a second mortgage. So you keep your first mortgage in place, and we just put a second mortgage behind it, tapping into that equity. Couple things about a home equity line of credit. They are adjustable rate mortgages, and you cannot, the last point here is you cannot misrepresent the occupancy. So many times we have this come up as an issue. And in all of these, you have to understand that underwriters, mortgage companies, we all go out there and we make loans based off the information that we're given by our clients. And what I find a lot, and what can get you into a pickle, so to speak, is you go out there and you pull out a home equity line of credit. And then once that home equity line of credit is done, you turn around and go make an offer on an owner-occupied house. But what we'll be asking for, since it's a new line of credit, we're going to be asking for the mortgage note. And if we see that mortgage note was done as an owner-occupied residence, it brings into question the legitimacy of your occupancy going into the new house and whether or not that mortgage lender will underwrite it. So you want to definitely underwrite the home equity lines of credit as an investment property, not an owner-occupied property. On the third page of the application, it says, do you intend to occupy the house as your primary residence? That should be a no. So make sure that you don't do that. So another thing that you have to do is you have to qualify for all three mortgages: the current first mortgage, the new second mortgage, and then on the new house that you're buying, the new mortgage that's going to be on that house. So things to keep in mind. I alluded to it. HELOCs, home equity lines of credit. Think about them as a big credit card, right? Let's add Stacy back to the stream. Hey, Stacy, you're back.
Hey, sorry about that.
There we go. Welcome back. So home equity lines of credit, they're adjustable rate mortgages, and they are what's a prime is the index margin. Prime is the index that they're tied to. Sorry, I spaced that out. I'm actually looking out the window, and there's this big truck backing down my hill, and I'm trying to figure out what is going on. So distracted vision. So the prime rate set by Wall Street Journal, Dow Jones Industrial Average is 3.25, and then there's a margin based on your dynamic, right? So that culminates into your effective rate. So they are interest-only payments, which is nice, right? So they're not a fully amortized payment. You're not paying principal. You're just paying the interest that's accruing on that loan. And for a short-term financing option, that's super awesome. Because if your end goal is to sell the departing residence, you don't need to be paying a lot of principal down, because you're only going to have that loan for 6 months, however long it's going to take you to get it staged ready, and then to put it on the market, and then to get right now a dozen offers, and then pick one of the offers that's going to close in 30 days, right? So
hey, Keith, how long normally are those, like what's an average term of a home equity line of credit?
Yeah, home equity lines of credit, they are built on a 30-year fixed model, and they're cut into two sections. The first interest-only period is interest-only for the first 10 years of that loan, right? So for the first 10 years of the 30, you get interest-only of prime plus your margin, whatever that is, and then you're paying interest-only. Then at the year number 10, you flip to a 20-year amortization, because the bank at that point wants their money back. So instead of interest only, you're going to go to a 20-year amortized, full principal and interest payment, and you got to pay that back in 20 years. We get lots of calls from clients that get the letter in the mail stating, hey, your HELOC is going to turn to a fully amortized payment and go up by $1,000 starting in 2 months. Do you want to refinance? And then they start calling us up. Oh my gosh. But yeah, so HELOCs really have two different lifespans. Lifespan number one is the draw period, interest only period. And then section number two, life number two, is the fully amortized payment that you're paying principal and interest. So cool thing about this, using it as a transitional bridge financing option, is the HELOC can just really mitigate your payments, and you're only paying the small interest only payment while you're dealing with selling that departing residence.
So, and how will, when you're looking at getting approved, how will this line of credit factor into your debt to income?
That's a good question. So here, when you go to buy that next house, you will have to take into account that HELOC payment, right? So they're going to ask you for your mortgage note and say, well, how is the mortgage written? It's going to be on an interest-only payment of prime plus whatever your margin is, and that will be the payment that the underwriter uses to qualify you for the purchase of the new house. So you do have to qualify for your current mortgage, your new second mortgage, and the new house that you're buying. So super, super important. I put together a quick example of how this would look if you had, let's say you had a home that's valued at $800,000, and then you had a current mortgage balance of $500,000. We could do a non-owner occupied HELOC up to 80% combined loan to value. So that gives you access to $140,000 worth of capital. So that's a huge chunk of money. You're well on your way to a nice down payment on a higher loan amount. Maybe you're looking at $1 million house. You're looking at $1.2 million. You now have 10% plus closing costs to get you there. One other thing to keep in mind that a lot of people don't realize in the jumbo market, when we talk about that next step up, because the median household prices are such that once we get over $776,000, you jump into the jumbo market. And that jumbo market, they do have options to go to 10% down as far as getting a loan. And a lot of people think, oh, I'm in the jumbo market, I have to have 20% or more. That's just not the case. Again, get with your loan officer, understand your numbers and what they look like, and put together a plan and execute. So powerful, and it a lot of the times comes out in your favor that you can make these things happen a lot sooner than you thought and be a non-contingent buyer. So definitely conversations, like I said earlier, conversations are free. So have them.
Great advice.
Yeah. Any questions on the HELOC that you were thinking, Stacy?
No, I think you answered my questions. I don't see any in the comments, but I'm not sure I see the comments. You should check them.
Yeah, the cash out refinance I want to step into next. And I alluded to it earlier. It's one of the most overlooked options that people have. They think that they have to sell the house to get the equity out. And what a lot of people don't realize is you can do what's called a cash out refinance. It's not just getting a better rate. You're actually pulling the equity out of your house to go utilize it. A lot of cash out refinances come in the form of debt consolidation, right? We think of them very highly and very commonly to, oh, well, let's get rid of the credit card debt. Let's pay off the car. Let's help finance kids in college. Let's pull the equity out and go do these things. And so often homeowners that are sitting on a ton of equity, they forget that they can do a cash out and use that equity as their down payment for the next house. Super powerful. And again, one thing that we want to keep in mind is it's not adding a mortgage like we do with a HELOC. We're actually going to pay off your old mortgage, right? So that one goes away. We're going to give you the equity out, and that's your new mortgage on your departing residence. Since it is indeed your departing residence and your intent is to buy a new owner-occupied house, we would then underwrite that as a non-owner-occupied investment cash-out refinance. I know that sounds like a big mouthful, but it's not too scary. Just think about cash-out investment property since you're not going to be there living there. So the only downside that I see to the investment property cash out is it's got a smaller loan to value. You can only leverage up to 75% of your house's worth, which is not as much as you can do with the HELOC. The HELOC will go to 80%. We can only do 75% on the cash out refinance. Similar to the home equity line of credit, you got to qualify for the departing mortgages on the departing residence and the new mortgages on the house that you're buying. So we will take into account this fully impounded principal, interest, taxes, insurance payment into the calculation for debt to income.
So that is, we'll go back a screen really quick. There's also more closing costs in this option than the home equity line of credit.
There's also what?
More closing costs.
Yeah, that's a good point. Yeah. So this is a refinance. So you're going to look somewhere in the ballpark to $4,000 to $6,000, maybe more, as far as closing costs based on taxes, insurance, underwriting, processing, appraisal costs, and all that stuff for your house. So there is more closing costs associated with a cash out refinance in a first lien position. Home equity lines of credit in a second lien position, they don't have stuff like prepaid taxes, prepaid homeowners insurance, because you're paying all that in your first mortgage payment, not in the second. That's a huge difference. One thing I forgot to mention, must qualify for departing resident payment unless rented.
Yeah, let's talk about that.
Here's another great thing with doing the cash out refinances, either in the form of a home equity line of credit or in a straight up cash out first mortgage, right? Great thing that you can do if you intend to hold on to the departing residents. Some folks want to venture down the path and say, hey, I'm ready to be a landlord. I know I need to access the equity in this house, but I don't want to like get rid of it. I want to rent it out. I want to generate some cash flow on it. And I also want to reap the benefit of the appreciating market, right? So how do I do that? If you intend to keep your departing residence and you've rented it out, we can actually use part of that rental income when you have a lease, the down payment for the deposit and the first month's rent. If you have those things in place, we can actually use part of that rent to offset the departing resident's mortgage payment. So that allows you to actually qualify without all three of them in the HELOC, or all two of them, the departing residents and the new mortgage on the new house that you're buying. You don't have to take all that burden into your debt to income. We can use some of that rental income to offset. Super, super powerful stuff to allow people to continue to max leverage and keep going. I don't want to get too far on leverage, because that's a really deep financial conversation. But the gist of it is, a big asset that appreciates at a lower rate of return is better than a small asset that appreciates at a very little rate, or at a very moderate rate of return. So I'm going to park that there. But what's your question, Stacy?
What type of documents would a client need to be prepared to share if they were renting their departing residence?
Yeah, so you got to have a rental agreement in place, and it's got to be a 12-month rental agreement. They have to show that the new tenant has given them a deposit for security deposit as well as first month's rent. And if they have those three things in place, we can use that new lease in consideration of income and offset a portion of the mortgage on the departing residence.
Great, thanks.
Yeah, super powerful. So in that case, you don't have to sell the departing residence. You can just offset it with a rental agreement and buy another house. So I did an example. I used the same values and the same mortgage balances as the first one. If you had an $800,000 home, you could leverage it up to 75% loan to value, which is a $600,000 loan amount, minus the outstanding mortgages. So you'll have roughly about $100,000 as a down payment, which again is a 10% down payment on $1 million. So
yeah, or maybe someone's downsizing.
Come again?
Someone could be downsizing. I'm sorry for my echo. I don't know what's going on.
Oh yeah, absolutely. Somebody could be downsizing. So they could be going from an $800,000 house to a $500,000 house. And now look at that. You've already got your 20% down. Yep. Super powerful. Yeah, this goes up or down. That's a very good point. I didn't add it to this. That was actually, I used to teach this course to real estate agents on a quarterly basis. And that was one of the questions that came up that I had to add to my presentation that I didn't bullet point in here. I must have an older version because I do have that bullet point. These options work going up in value or down in value.
Yeah.
So cash out refinance, super quick, super clean, super straightforward, often overlooked, right? Often overlooked. So keep that in mind. Cash out refinances, super, super powerful way to do it and a clean way to do it. Okay, so this is by far the most complicated transaction, in my opinion, in the mortgage space, is the cross-collateralization. So cross-collateralization is a very unique opportunity. right? So it's going to be a mortgage on two properties, hence the name cross collateralization. So we're going to take your departing residence and we're going to take your new house that you want to buy and we're going to add the values together. And then that's how we're going to lend. We're going to leverage both properties' value and give you a loan amount. We'll talk about the math in a minute, but just think about that. We're taking the two combined assets, slamming them together, and that's what we can lend off of their combined strengths and their combined values. They come in adjustable rate mortgages, 30, 15, and they come in fixed rate mortgages and adjustable rate mortgages. So 30-year, 15-year fixed rate mortgage, or you could go with a 5-year or 7-year ARM. Completely up to you, however you want to do it, whatever your risk tolerance as far as rate is concerned, it can address those concerns. The coolest part, and this is where it gets really complicated, the coolest part is once we do the cross collateralization loan, you move into your new house and you sell your departing residence, right?
Yeah.
So we're gonna take the mortgage and record it against the departing residence, and the portion that's recorded against the departing residence is then paid off, right? You sold the house, the new purchase money mortgage paid off the underlying liens on your departing residence, and now guess what? The mortgage recasts. It's a new payment that's then amortized over however many years is left in the loan. So say you do a 30-year fixed and it takes you a year to sell your departing residence, then you're going to amortize, recast that mortgage over the next 29 years, or however many months are left in your loan, which is super powerful. Yeah, you have to take this big loan to begin with, but once you get rid of that departing residence, your mortgage comes down into a more palatable position. Super powerful.
This is a great option. What's like the average down payment someone might need to be prepared for between the?
And that's where it gets tricky. Average down payments. I've had positions where there was so much equity in the departing residence, they actually didn't have to come in with funds to close because it covered the 25% down required, right? So the down payment requirement from a blanket statement is 25% down, right? Between the combined loan to values of the two assets. If there's enough equity in your departing residence, you actually don't need a down payment. Again, get with your loan officer, understand your numbers and what that all looks like, so you know what you have to come in with. So the last thing is you only qualify for this payment, right? That's the only payment on the board. There's no departing residence mortgage. We're paying that off with the cross collateral. There's no second mortgage because we're doing a cross collateralization loan. So here's how the numbers work, and this is where it gets complicated, right? So your departing value is $800. Your departing mortgage balance is $500,000. Your new home value is 1.25. So if we take the 1.25 and add it to the departing house's value, we have a total asset base of $2,050,000 or $50,000, right? So we can leverage that up to 75% cross-collateralized loan to value, right? So 75% is 1.53 million right here. Oops, hold on, let me go back. Right here. And so of this new mortgage balance, we have to pay off the departing residence mortgage of the $500,000, which means the fund for the new purchase will be 1.037 and $500. So it's leaving you a down payment of $212,500 or 17%, right? So Stacy, to your point, what's the down payment? I've had people where they've had houses that are $800,000 and have like $150,000 of debt on it. Those folks, they could do a cross collateralization loan and have zero requirement for a down payment.
Yeah, this is a great program. Yeah, a lot of people don't know about it. There's actually more than the three you talked about, but so if one of these might make sense for any of you watching, please reach out to a local mortgage professional and they can walk you through additional ones. But these are definitely the main ones that you would see.
Yeah, these are the three main buckets. There's some other stuff out there in the market. There's probably about three more options that we didn't cover. These are these are the most powerful, most highly utilized options out there for you, a homeowner, or our real estate agents out there that have clients to say, hey, I would really love to live with you, Mr. Agent, Mrs. Agent, but guess what? You know, all my equity is tied up in this house. I can't do it. Uh, that's a great conversation starter right there. Well, have you talked to a mortgage planner about tapping into the equity and not being contingent, right?
Yeah.
So we want to help create some more inventory, and this is an inventory creator. We've got to spread the word. So if you know anybody that wants to buy a new house and they don't want to move twice. I think you mentioned it earlier, Stacey. People don't want to end up moving twice. They just want to move once. Or I literally have a client right now that they sold their house and they said, you know what, we're just going to deal with it. They're sleeping in their parents' basement. They're not happy. Their kids aren't happy. It's a stressful situation that we could work through. In their case, they didn't have enough equity, but there are lots of people out there right now that have a lot of equity that would prefer to move. They just don't know how to, and we'd love to help them out.
Yes, great. So much great advice. Thank you, Keith.
Yep, free. Conversations are free. Take them up. That concludes our first educational mortgage nugget, I guess. So if you guys have any questions in the mortgage space that you want us, because we're going to do this once a month, we'll have one of our shows every month will be about mortgages, so we can help our realtor partners, we can help our consumer public out there, our homeowners or our want to be homeowners get into housing. Let us know, drop us a line. Let us know what you guys want to hear about so we can address it. That would be super effective for us and beneficial to you. So we'd love to hear what you want to know about.
Definitely. And I gotta figure out the camera. I feel like I'm just this head floating around.
Yeah, is that the one that's on the little mount that's up in
I don't know. I am not in the office enough, clearly.
Maybe we'll have to get another one of these cameras that you sent to me so we can do it that way. So
yeah.
Well, right on. If you guys have any other questions, don't hesitate to let us know, and we'll see you next Thursday because we are out of time. We've overrun our time, and enjoyed it. And we'll see you next Thursday at 10 a.m. Have a great